Welcome to our news channel. Today we will discuss, what if I told you that in just 10 days, a war that started thousands of miles away has already pushed oil above $119 a barrel, wiped out billions in stock market value, triggered circuit breakers across Asian exchanges, and quietly started raising the price of groceries, mortgages, and gas at the pump for everyday Americans? That's not a future scenario. That is your financial reality, right now, today. March 10th, 2026. And if you're not paying attention to what's happening between the United States, Israel, and Iran, and what it's doing to your money, you're already behind. Stay with me because in the next 10 minutes, we're going to break down exactly what happened, what's happening right now, and where markets are most likely headed next. Section 1. How it all started. To understand why markets are shaking, you need to understand what kicked this whole thing off. On February 28, 2026, the United States and Israel launched a joint military operation, what the Pentagon is calling Operation Epic Fury, a coordinated series of airstrikes targeting Iranian leadership, military infrastructure, and nuclear facilities across Tehran, Isfahan, Qom, Karaj, and Kermanshah. In those opening strikes, Iran's supreme leader Ali Khamenei was killed. That single event changed everything. This didn't come out of nowhere. Back in January, President Trump had publicly threatened a military intervention if Iran harmed peaceful protesters. By mid-February, the USS Abraham Lincoln and USS Gerald R. Ford carrier strike groups were both positioned in the Middle East. The buildup was visible. Markets had somewhat priced in the possibility of military action, but what nobody fully priced in was Iran's response and the economic shockwaves that followed. Iran retaliated almost immediately, launching hundreds of drones and ballistic missiles at U.S. military bases across Qatar, Bahrain, the UAE, Kuwait, Iraq, Jordan, and Saudi Arabia. Iranian forces also forced the Strait of Hormuz to close, and that, right there, is the single most devastating economic decision in this entire conflict. Because the Strait of Hormuz is not just a waterway. It is the financial jugular vein of the global oil market. Section 2. The Strait of Hormuz, the $119 barrel story. Here's the number you need to understand. Roughly 15 million barrels of crude oil pass through the Strait of Hormuz every single day. That's approximately 20% of the entire world's oil supply, all moving through a narrow choke point that is now effectively blocked. With Iranian missile and drone threats making tanker navigation through the strait nearly impossible, about 200 ships are now just floating, stranded in the region, waiting. And it's not just the strait. Saudi Aramco's massive Ras Tanura refinery and crude export terminal has shut down after Iranian attacks. Qatar, which supplies 20% of global liquefied natural gas, declared force majeure on its gas exports after Iranian drone strikes. Experts say it could take at least a month before Qatar's LNG exports return to normal. When you combine all of that, the blocked strait, the damaged refineries, the grounded tankers, you get Brent crude jumping from around $70 a barrel before the war to a peak of $119.50 in just 10 days. That's a 70% spike in oil prices in under 2 weeks. To put that in perspective, the last time oil moved like this was when Russia invaded Ukraine in 2022. And for Americans, this translates directly. The national average for a gallon of gas hit $3.41 over the weekend, according to AAA, up 43 cents in just 1 week. Goldman Sachs economists are now warning that if this drags on, inflation could snap back to 3% this year, completely reversing the progress made in bringing prices down. Every sustained $10 increase per barrel of oil costs the average U.S. household close to $450 extra annually. That number compounds fast when oil is up by nearly $50 a barrel. What it's doing to us markets. Now let's talk about your portfolio. Because this war is creating the most volatile market environment we've seen since last year's tariff shock, and possibly since the 2022 rate hike cycle. On Monday, March 9th, U.S. stocks opened deep in the red. The S&P 500 was down more than 1.5% intraday. The Dow had already lost over 400 points on March 2nd alone in the opening days of the war. The VIX, Wall Street's fear gauge, topped 30 for the first time since April. But then, something remarkable happened. President Trump told CBS that the military operation was very far ahead of schedule, and the conflict was pretty much complete. Markets reversed immediately. The S&P 500 recovered all its losses and ended the day up 0.9%. The Nasdaq surged 1.3%. That kind of swing, from minus 1.5 to plus 0.9 in a single session, is not normal. That is a market on a razor's edge, moving on every word, every tweet, every headline. The sectors being hit hardest tell the story clearly. Airlines are down 3% or more. Delta, American, Alaska all in the red, because jet fuel prices are directly linked to crude oil. Financials as a whole are down 10% for the year, and private credit giants like Blackstone, KKR, and Apollo are down 26 to 33%. Cosmetics brands like e.l.f. Beauty are down 8%, hit by higher petroleum-based input costs and a consumer that's suddenly thinking twice about discretionary spending. On the other side, defense stocks are surging. RTX, Lockheed Martin, and Northrop Grumman are all up 3 to 4% month-to-date. Broadcom and AMD both jumped over 4.6% on Monday as tech recovered its footing. And gold, the classic safe haven asset, is rising strongly as investors seek protection from the chaos. The U.S. dollar index gained nearly 1% and is trading at its highest level in 5 weeks, as investors pile into it as a store of value. Global shockwaves. This isn't just an American story. The ripples from this war are hitting every corner of the global economy, and some markets harder than others. In Asia, the damage has been severe. South Korea's Kospi triggered a circuit breaker and fell 7.72%. Japan's Nikkei sank 6.45%. Taiwan's index dropped nearly 5%. These economies import roughly 90% of the oil that passes through the now disrupted Strait of Hormuz, so the supply shock hits them far harder than it hits the United States, which has significant domestic oil production to buffer the blow. European markets are down more than 2%. The UK's Akrotiri military base on Cyprus was struck by an Iranian drone, marking the first time NATO-adjacent territory has been hit. U.S. non-emergency government employees have been ordered out of Saudi Arabia. The UAE and Qatar, two of the world's most important financial and energy hubs, are caught in the middle, with thousands of flights grounded and major airports shuttered. Dubai International Airport, the busiest in the world, was completely deserted for days. Former Federal Reserve Chair Janet Yellen has issued a stark warning. Depending on how this oil shock plays out, the Fed's job of containing inflation becomes dramatically harder. The 10-year Treasury yield has climbed back above 4.15%, driven by inflation fears. Mortgage rates are rising again, moving in lockstep with Treasuries. For American homebuyers who thought relief was finally coming, this war may have just frozen the housing market all over again. What happens next? This is the critical question, and I want to be honest with you, nobody knows for certain, but we can map out the most likely scenarios based on what we know right now. The first scenario is a swift resolution. Trump has said the operation is ahead of schedule. If Iran agrees to some form of ceasefire or regime transition quickly, oil could drop sharply, potentially back toward $85 to $90. Markets would likely rally hard. The S&P 500 historically tends to recover within 6 months of major geopolitical events, often gaining 3 to 4% in the months after the initial shock. If you believe this resolves fast, this dip may look like an opportunity in hindsight. The second scenario, and the one markets are now beginning to seriously price in, is a prolonged conflict. Trump has stated flatly that the war won't end without Iran's unconditional surrender. Iran named Mojtaba Khamenei, the son of the assassinated supreme leader, as the new leader. Israel has warned that any successor to Khamenei would also be a target. Iran is still firing at Saudi Arabia, calling the ceasefire off. The grace period the market was giving this conflict is officially over, according to analysts at CSIS. This is becoming a multi-front crisis touching the Levant, the Caucasus, the Gulf, and now NATO-adjacent territories. If this drags on for months, Goldman Sachs warns that oil above $100 creates a qualitatively different economic shock, one that could tip the global economy into recession. The third thing to watch is what the G7 does with strategic oil reserves. Over the weekend, sources confirmed that G7 nations are actively discussing coordinated strategic petroleum reserve releases. That alone helped pull oil back from $119 to around $112. If they pull the trigger on a major release, similar to what happened after Russia invaded Ukraine, it could temporarily cap oil prices and give markets breathing room. Watch for that announcement this week. It would be a major market-moving event. On the Fed front, the central bank is now stuck between a rock and a hard place. Higher oil prices are inflationary, which normally calls for rate hikes. But the economic slowdown and consumer spending pressure call for cuts. This is the definition of stagflation: rising prices with slowing growth. And it's the scenario every economist feared. The Fed is almost certain to hold rates steady at their next meeting, but the longer this drags on, the more pressure builds for them to make an impossible choice. This week, there are 3 specific catalysts to watch extremely closely. First, Treasury note auctions on Tuesday and Wednesday, the first major auctions since the war began, will reveal just how much confidence the bond market still has in the U.S. Second, inflation data due this week will show whether energy prices are already feeding through to consumer prices. Third, Oracle reports earnings, and its guidance could signal whether corporate America is starting to feel the uncertainty. Any one of these could be a significant market-moving event in either direction. So let me bring this all together for you. 10 days ago, a war started in the Middle East. Today, oil is near $113 a barrel. Gas is above $3.40 at the pump. Your mortgage rate just crept up again. Asian stock markets had circuit breakers triggered, and Wall Street's fear gauge is above 30. The U.S. economy, which was already being squeezed by tariffs, slow growth, and stubborn inflation, just absorbed another massive shock. The next 2 to 4 weeks are going to be some of the most consequential weeks for financial markets in years. If this conflict ends quickly, we may look back at this moment as a buying opportunity. If it drags on, if oil holds above $100, if the strait stays closed, if Iran keeps hitting Saudi and Qatari infrastructure, we could be looking at a genuine stagflationary recession. The market is telling you it doesn't know which way this goes. That VIX above 30 is the market saying, buckle up. What I tell you right now is this: watch oil. Watch the G7 strategic reserve decision. Watch the tone from the White House on whether unconditional surrender is still the stated goal. And watch those Treasury auctions this week. Those 4 things will tell you more about where markets go next than almost anything else. If you found this breakdown useful, smash that like button. It helps get this analysis to more people who need it. Subscribe so you don't miss our next update when the situation develops. Drop a comment below. Do you think this resolves in weeks, or are we looking at months of market chaos? I read every single comment. I'm Guess, and I'll see you in the next one.